a look at the fixed income market now. I'm joined by Tom Atteberry, Portfolio Manager of the FPA New Income Fund. Good to see you here in New York.
See you again. Thank you.
And it's always fun to chat with you because you take a bit of a contrarian twist in the way you approach the markets. So when you look in your world right now, how much risk is there compared to a few months ago, and how much opportunity are you seeing?
So to step back and first just remember what one is doing in fixed income. Okay, you're making an investment that's asymmetric. You already know what your upside is because if you own the bond until it matures, you get the yield to maturity. That's all that you receive. So you get the coupon and your principal back. So in an environment like today, we are at very historic low levels for yield. When I mean historic low levels, you can go back 5,000 years and you can't find where you are. You realize, okay, what do I have? Well, I've got a very low level of income. And now you find if, other than that income level, if you're going to get anything, it's going to have to be capital appreciation. Well, that's not really what a bond was designed for. It's a fixed return. Capital appreciation is more of an equity-oriented concept that people go through. So when you look at today, you realize, okay, I'm getting very little income. My return maybe get more and more of the fact I'm going to make some, lack of a better word, bet that interest rates are going to decline for some reason to make yield go up, like prices go up. And they go, that doesn't make sense. You're trying to get that instrument to do something it really wasn't designed to do, and now it's at a much more extreme level. Carry further, you look at what return is. I'm just looking sort of like at a Barclays, I guess now Bloomberg Barclays aggregate index. Where did its return come from? And you can look at the data and it'll tell you price return, it'll tell you income return. And you realize that the income return you're getting is declining, the price return you're getting is increasing. Well, why is it increasing? Well, that's just because rates have gone down. Yeah. But historically, it's very much out of balance.
So what are you doing then in terms of the fund?
So you realize with that, okay, what is the role that I as a bond manager play? I'm usually the less aggressive, the more conservative portion of someone's portfolio. You might be the anchor for their portfolio. You're supposed to do well when equities do poorly, those sorts of things.
You're supposed to be safe.
I'm supposed to be safe, right? Yeah, this simply is just supposed to be. So what do? It says, okay, I need to make this safe. Well, how's the best way to do it? Well, you sit and go, I need to have less interest rate risk or duration in the portfolio. So in our case, it's about 1.3 years. Now ours tends to be shorter than many others, but one of them is because we have a mandate that we go on, a goal that we have that says, okay, I want to have a positive return in a 12-month period of some sort. So that governs how much of that risk you can take. Then there's one, okay, I could take credit risk. Well, you need to get paid for the fact that someone may not pay you back.
Yeah, but you're not doing that, right? You have a lot of AAAs.
We don't do much of it because when you think about purely just high yield as an example, you realize that the yields you're getting, yes, it looks high relative to everything else, but it's not high by its own historic standards. And two, the leverage those companies have has been increasing. And the third, sort of from a macro and an economic standpoint, our economy's not growing real well. It's growing by 1%, 2%. Yeah. I mean, it's hardly to get excited about. Well, if you don't have a lot of growth and these companies have a lot of leverage, how are they going to refinance when it comes time to refinance, or how can they pay that debt off?
With difficulty is how they're going to do it.
Yeah, that's pretty much how it's going to
So you mentioned duration then, what about the actual instrument that you feel will give you a little bit of safety and maybe just a little bit more yield that'll work?
So in an uncertain world that we have, and I use this one as an example, it's okay, we've got a 1 or a 2% growth rate here, the unemployment rates decline, but things are not great, but they're not horrible. We find that looking into the asset-backed securities market and having an asset-backed security backed by auto loans, maybe subprime auto loans, is okay. And the reason is the car is used to get to work, the unemployment level is low.
What about car sales peaking though, potentially? 11%?
These are used cars. These people don't have the credit or the ability to really buy a new car. So you're looking at a car that's 3 years old, maybe 4 years old. And you look at that and realize, okay, as long as the economy just says sort of okay, and that person has a job, they'll pay me on the car loan because that's how they're getting back and forth from work or dropping the kids off to school or whatever that family and household's doing. And we find that because of it says subprime and people get nervous about it, it'll tend to have a slightly higher yield.
Well, it's always interesting to get an investment idea from you because you definitely think, I think, a little bit outside of the box. So Tom Atteberry, it's been great speaking with you once again.
Thank you very much.
I'm Rhonda Schaffler for The Street.